Well, welcome to the Deep Dive. Today we are undertaking a masterclass in dissecting real estate giants, and our target is the undisputed behemoth of the Singapore market, CapitaLand Integrated Commercial Trust.
Ticker C38U.
That's the one. And we are working with freshly updated data right through July 2026, which gives us this really pristine vantage point on their recent string of mega deals. And to navigate a portfolio this complex, because, we're talking massive retail, grade A office, integrated developments. This is part one of an ongoing definitive series. But starting with management is critical, right? Because in the externally managed REIT structure, management's capital allocation decisions are the absolute sole driver of long-term DPU compounding. Right. So CICT is externally managed by CICT-ML, which is a wholly owned subsidiary of CapitaLand Investment Ltd, or CLI.
Right. The sponsor relationship, which really dictates every single strategic move the REIT makes. I mean, you have to remember, you buy units in C38U, but the people actually making those multi-billion-dollar acquisition decisions,
they don't work for C38U.
Exactly. They don't actually work for the REIT. They are employed by the sponsor, CLI.
Now, intuitively, having CLI as a sponsor sounds like this incredible moat, right? It's like having a wildly wealthy parent with a massive real estate portfolio.
Yeah.
But does having a rich parent actually benefit the everyday investor?
Well, the mechanism that formalizes that advantage is the reciprocal right of first refusal.
The ROFR.
The ROFR, exactly. The July 2021 disclosures from CapitaLand laid this out very clearly. If CLI wants to divest a prime commercial asset, they essentially have to offer it to CICT first.
They get first dibs.
Right. The REIT gets first dibs before the asset ever hits the open market.
Which is huge.
It's massive because it eliminates all the friction and, frankly, the uncertainty of open market bidding. I mean, if a trophy asset in Singapore hits the open market today, you are suddenly bidding against sovereign wealth funds.
Oh, yeah, global private equity firms.
Exactly. Aggressive family offices. The ROFR pipeline guarantees CICT this steady, incredibly high-quality diet of assets without them having to engage in these value-destroying bidding wars.
And we've seen this silver platter delivered time and time again over the last 2 years.
Oh, yeah.
I mean, just look at the sheer scale of these pipeline deliveries.
Yeah.
In October 2024, CICT swallowed a 50% stake in Ion Orchard directly from CLI.
A monster deal.
Huge. Then in August 2025, they took that 55% stake in Capita Spring from CapitaLand Development. These aren't like peripheral assets out in the suburbs. They are the absolute centerpieces of Singaporean commercial real estate.
They're the crown jewels.
Exactly. Yeah. But the family dynamic here, it actually extends beyond just the immediate parent. Let's talk about the upcoming Paragon deal.
Right.
This $3.9 billion monster that's scheduled for an EGM on June 10th, 2026. This one is sourced from Cascade & Peak.
And what's fascinating here is Cascade & Peak is backed by Temasek.
Right.
This is where the structural advantage of the entire CapitaLand ecosystem really flexes its muscle. The April 2026 documents, they clearly note Paragon as an interested person deal, but technically it falls outside CLI's traditional ROFR pipeline.
Right, because Cascade & Peak isn't CLI.
Exactly. But Temasek is the ultimate major shareholder hovering above this entire ecosystem.
It's like the grandparent.
Yeah, essentially. So CICT is leveraging its position not just with its direct parent, but they're utilizing this broader Temasek Link network to secure a $3.9 billion trophy asset. It's essentially an arbitrage on corporate access.
But, and this is a big but, this brings us to the inherent tension of the externally managed model. The pipeline is massive, yes. The assets are world-class, yes. But the manager sits right in the middle, employed by the parent who is selling the asset, while theoretically representing the REIT that is buying the asset.
Right.
The parent obviously wants the highest exit valuation, right? And the REIT needs the absolute lowest entry valuation to make the yield accretive.
It is the defining conflict of interest in the entire sector. And honestly, the only way to measure how that conflict is actually being managed is to forensically examine the fee structure.
Follow the money.
Exactly. How aggressively is the toll booth extracting value as capital flows from the parent into the REIT and ultimately down to you, the unit holder?
Right. So let's strip down this fee structure. The 2024 annual report shows a base fee of 0.25% per annum of deposited property.
Okay.
Now, at 0.25% on a portfolio worth tens of billions, it's obviously a substantial absolute dollar amount. But as a percentage, it's highly competitive.
Very.
Like if we look across the aisle at CapitaLand Integrated REIT, Claire, their 2025 reporting shows a base fee of 0.5%.
Literally exactly half the base fee of its own sibling.
Yeah.
Which is great. On this specific metric, CICTML is really demonstrating a high degree of shareholder alignment. A 0.25% drag on gross asset value is about as lean as you'll ever find in the large cap commercial space.
Here's where it gets really interesting, though, because a 0.25% base fee is only half the story.
Right.
The real extraction happens in the performance fee, and this is where the structure becomes highly, highly problematic. CICT charges a performance fee of 4.25% per annum of net property income, or NPI. Now, the Corporate Monitor report from May 19, 2026, they pull absolutely no punches here. They explicitly label this a pseudo-performance fee.
And they are entirely justified in using that terminology. I mean, linking a performance fee to NPI is just a massive structural misalignment of incentives.
Why is that? Break that down for the listener.
Well, net property income merely reflects the operational revenue of the buildings minus the direct property expenses.
Right, so rent minus, like, maintenance and property taxes.
Exactly. It ignores the cost of capital entirely. It ignores the massive debt burden used to acquire the asset. And crucially, it completely ignores the share count. So think about it. If management decides to go on this massive debt-fueled acquisition spree, or they issue billions in new units to buy a dozen new malls, the total NPI of the REIT will objectively rise, right?
Because they simply have a larger absolute pool of rent-generating assets.
Exactly. Therefore, the 4.25% performance fee rises, and management gets a massive pay raise.
Even if the actual DPU, the actual cash flowing to the listener holding the units, collapses.
Precisely.
Because of the massive share dilution or, the crushing interest expense on the debt they used to build that empire.
Right. The management is financially incentivized for absolute scale, not per unit value creation.
Which is wild.
It really is. A genuine performance fee would be pegged directly to DPU growth or maybe total shareholder return relative to a peer index. But by pegging it to NPI, management gets paid whether same-store organic growth is positive or negative, so long as they just keep acquiring. It literally rewards sheer bulk.
And this empire-building incentive makes the transaction fees even more critical to look at. Because if they're incentivized to keep buying just to pump up NPI, they're also collecting fees every single time they swipe the credit card.
Oh, yeah.
The 2021 annual report standardizes their transaction fees at 1.0% on acquisitions and 0.5% on divestments. Now, the sources do confirm these are perfectly in line with sector norms.
Yeah, they are.
But the Corporate Monitor report correctly highlights a massive omission in corporate governance here. CICT applies absolutely no related party fee discount.
Yeah, and this is a glaring negative when you're evaluating management alignment. Progressive REITs will very often mandate a 50% discount on acquisition fees when the asset is sourced from the sponsor.
Because the logic is undeniable, right? I mean, the 1.0% acquisition fee is designed to compensate the manager for the heavy lifting of open market origination.
Right. Scouting assets, conducting independent due diligence.
Surviving competitive bidding.
Exactly, and structuring really complex third-party negotiations. But when you are buying Iron Orchard directly from your own parent company, the origination friction is effectively zero.
It's just an internal memo.
Basically, yeah. The deal is engineered completely in-house, so charging the unit holders the full 1.0% fee, which, by the way, amounts to tens of millions of dollars on these mega deals.
Huge money.
Charging that full freight for an internal transfer is just aggressive value extraction.
Yeah, it creates a scenario where the sponsor benefits twice. They get to recycle their own capital by offloading a mature asset at a premium valuation to their captive REIT, and then their subsidiary management arm clips a massive 1.0% transaction fee just for facilitating the internal handoff.
It's double dipping.
It really is. So, just synthesizing the fee structure here. We have a lean, highly competitive 0.25% base fee. Great.
Good start.
But that is heavily offset by a pseudo-performance NPI fee that incentivizes just blind empire building, coupled with full freight transaction fees on related party deals. The toll booth is definitely busy.
Very busy.
So the ultimate question becomes whether the cash they actually deliver to the unit holder justifies the toll they are taking.
Yeah.
We need to look at the holy grail of REIT investing, which is the distribution per unit track record.
Because the DPU is the ultimate lie detector.
Yeah.
You can manipulate NPI all you want, you can inflate gross asset values on paper, but you absolutely cannot fake the actual physical cash deposited into a shareholder's brokerage account every single quarter.
Nope, that is hard truth. And looking at the CICT financial results spanning February 2023 to February 2026, the DPU trajectory is undeniably robust.
Strong.
Very strong. FY22 came in at 10.58 cents. FY23 bumped up to 10.75 cents. FY24 hit 10.88 cents.
Right.
And then FY25 delivered this massive leap to 11.58 cents. We are talking about a plus 6.4% year-over-year jump in FY25. Delivering that kind of growth during a macro cycle that was basically characterized by sustained high interest rates and compressed commercial real estate valuations globally, that is a massive testament to their operational execution.
It is a phenomenal headline number, truly. But if we connect this to the bigger picture, we must weigh that against the structural critique we literally just established regarding their NPI pseudo-performance fee.
Okay, lay it out.
So the 2025 annual report shows a 3-year DPU compound annual growth rate, right, the CAGR, and that's sitting at approximately 3.1%.
Okay.
However, the 3-year AUM CAGR, the growth of the total empire, is sitting at approximately 3.6%.
So the AUM is growing slightly faster than the DPU.
Exactly, which perfectly validates the critique of the NPI fee structure. The management is growing the overall gross asset pie at 3.6% a year, which pumps up their total NPI and, naturally, their resulting management fees. But the actual cash flow scaling down to the individual unit holder is lagging behind at 3.1%. Now, it is not a disastrous gap. I want to be fair here.
Yeah, it's a 50 basis point difference.
Right. We're not seeing a nightmare scenario where AUM is growing at 10% while DPU is actually contracting. But it does mathematically prove that a portion of the REIT's growth is, frankly, dilutive to the existing unit holders.
Right. They're getting a slightly smaller slice of a much bigger pie.
Precisely.
But, while the AUM versus DPU gap is a mild negative, I have to say I was actually shocked when looking at the underlying quality of these distributions.
Oh, it's very clean.
It's so clean. I mean, in a market where sponsors are constantly utilizing financial engineering to mask weak asset performance, I always look for 2 specific red flags: income support and aggressive unit dilution. And both are entirely absent here.
Which is huge. The zero income support over the past 3 years is a massive indicator of earnings quality.
Let's explain that. Because for those tracking the darker arts of REIT accounting, income support is, well, it's tricky.
It's very tricky.
It's when a sponsor sells a newly developed, maybe half-empty commercial asset to the REIT and artificially guarantees the rental income out of their own pocket for a few years just to make the yield look accretive on day one.
Exactly. It creates this temporary sugar rush for the DPU.
Right.
And then, when the support expires, if the building hasn't organically leased up in the meantime, the yield just collapses.
The bottom falls out.
Yep. So the fact that CICT is generating 11.58 cents organically entirely from underlying tenant cash flows without any synthetic sponsor top-ups, that means the yield is structurally sound.
And equally important is how they are choosing to take those massive management fees we discussed earlier.
Yes, the fee in units dilution.
Exactly. It sits at just 0.4% to 0.5% of total units per year across FY24 and FY25.
Which is nothing, relatively speaking.
It really is nothing. I've seen other REIT managers take 100% of their base and performance fees in newly printed shares, diluting the existing investor base by 2% to 3% annually just to avoid paying themselves in cash.
Which artificially inflates their distributable cash in the short term, but kills you long term.
Exactly. But by keeping dilution pegged at a negligible, like 0.4%, CICT management is paying a substantial portion of their fees in cash. They are actively protecting the integrity of the DPU base.
Right. So we have a reality where the DPU is growing organically without synthetic income support and without aggressive equity printing.
Yeah.
So the question naturally becomes, if they aren't utilizing accounting tricks, how exactly are they engineering a 6.4% jump in a single year for a highly mature portfolio?
Right, because organic rent reversions alone, just raising the rent on existing tenants, that cannot drive that kind of torque.
No, absolutely not. So how do they do it?
They are running a massive, highly calculated trade-in program.
Mm-hmm.
Think of capital recycling, like trading in your trustee paid-off sedan for a luxury hybrid. You have to ensure the trade-in value and the new efficiency actually make mathematical sense for your wallet, right?
That's a great analogy.
They basically strip off older, plateaued assets, harvest the capital, and recycle it into higher-yielding mega assets. Capital recycling is honestly the only lever a mature REIT has to sustainably shift its yield curve.
Yep.
And CICT's recent execution here is just a masterclass in arbitrage. So let's break down the math on the specific deals, starting with the Ion Orchard acquisition in October 2024.
Okay, so the CapitaLand documents from September 2024, they clearly outline the yield spread here. The entry yield on Ion Orchard was 7.1%.
Against a distribution yield, again, effectively their cost of equity capital of approximately 5.5%.
Right.
This is the textbook definition of an accretive transaction.
Oh.
You are acquiring in a 7.1% cash flow stream using capital that costs you 5.5%.
It's beautiful.
It is. That 160 basis point positive spread flows straight through to the bottom line, which is exactly why the pro forma numbers showed a plus 0.9% to 1.2% DPU boost from this single deal.
It is clean, easily understandable arbitrage. The math just works.
Yep.
But as you highlighted right at the beginning in the introduction, not every deal possesses a clean headline spread like that.
Right. Let's revisit that Capita Spring magic trick from August 2025.
Okay, yeah, let's dig into this.
The entry yield was 4.2%. The distribution yield was 4.8%. Wait, the entry yield is lower than the distribution yield. How is this still accretive? Because on a purely unlevered basis, management is buying a negative spread. If they funded this entirely with equity, it would be heavily, heavily dilutive. So how does the source material justify a plus 1.1% pro forma DPU bump?
It comes entirely down to the mechanics of leverage and debt structuring.
Okay, walk me through it.
So a 4.2% entry yield is only actually dilutive if your blended cost of capital exceeds 4.2%.
Right.
The 4.8% distribution yield, that only represents the cost of equity. But management didn't fund this solely with equity.
They utilized cheap debt to bridge the gap. Okay, so if we model this out, assuming they utilize a standard commercial real estate leverage ratio, say, they fund the acquisition with 40% equity and 60% debt. And they secure that debt at a highly competitive interest rate of, hypothetically, let's say 3.5%.
The math suddenly inverts entirely. The 60% of the capital stack that's funded by debt at 3.5% is significantly cheaper than the 4.2% the asset is actually yielding.
Oh.
Right, so the asset is generating more cash than is required to service the interest on that specific tranche of debt.
Got it. And that surplus cash flow generated by the cheap debt tranche is then entirely allocated to the 40% equity tranche.
Exactly.
This artificially inflates the return on equity.
Yes.
The leverage takes an unlevered 4.2% property yield and pushes the levered return on equity high enough to clear the 4.8% distribution yield hurdle, resulting in that plus 1.1% final DPU accretion.
It's brilliant, but it requires immense discipline in debt origination. And frankly, it requires a macro environment where you can actually secure debt yields that are lower than grade A office cap rates.
Which isn't always a given.
No, not at all. But they executed it perfectly here.
And then, if we look forward to the pending Paragon deal, this $3.9 billion behemoth waiting on the June 2026 EGM.
Yeah, this one is huge.
The sources highlight a projected plus 90 basis point yield spread. On a base of $3.9 billion, a 90 BPS positive spread creates a massive absolute dollar surplus, which translates into a projected plus 1.7% pro forma DPU boost.
If that gets approved, it is a staggering injection of growth. Huge. But, acquiring $3.9 billion assets requires immense capital, obviously, and you absolutely cannot fund that entirely with debt without completely breaching regulatory gearing limits.
You'd blow right past the ceiling.
Right. You must recycle equity.
Which means we must analyze the sell side of their trade-in program, because selling mature assets efficiently is often vastly more difficult than acquiring new ones, right?
Oh, infinitely more difficult. Buying is easy if you have the money. Selling well is hard.
Exactly. But the divestment history here is exceptionally strong. The sources highlight the strategic exits of 21 Collier Quay and GSRT, both sold at solid gains. And more recently, the pending sale of AST2 at a 9.9% premium to book value.
Executing a divestment at a near 10% premium to book value in the 2025-2026 macro environment, that is a massive validator of management's internal valuation models.
It really is.
Because it proves they are not artificially inflating book values on the balance sheet just to pump up their AUM.
Right, because if the open market is willing to pay a 10% premium over the stated book value,
it implies the broader portfolio might actually be undervalued on the balance sheet.
Exactly. They were successfully harvesting mature assets at peak valuations and immediately deploying that capital into accretive mega deals within their sponsor network. It's this closed-loop system of value creation.
It's very efficient.
But, and again, there's always a but.
Yeah.
This entire system, the prime assets, the tight debt structuring, the premium divestments, is highly concentrated in a single geographic market. 94% of CICT's portfolio is in Singapore.
Which, to be fair, provides immense stability.
Sure.
Because your Singapore dollar rental income perfectly matches your Singapore dollar dividend distributions. You're entirely bypassing currency volatility on 94% of the book.
Right. But it leaves a 6% sliver of overseas exposure. Based on the FY 2025 results released in February 2026, we have a portfolio split evenly, right? With 3% in Australia and 3% in Germany. Now, 6% is objectively small, I get that. But on a portfolio pushing past $25 billion, a sudden structural devaluation of the Australian dollar or the euro can still vaporize millions of dollars a DPU if the forex risk isn't aggressively managed.
Because foreign exchange volatility is the absolute silent killer of overseas REIT expansions.
Yeah, you think you're making a 6% yield and then the currency drops 10% and you're underwater.
Exactly. But management's primary defensive mechanism here is the implementation of a natural hedge.
Right. And the mechanics of the natural hedge, detailed in the financial statements, they are quite elegant. CICT holds AUD 518.4 million in debt, directly matched against their Australian assets, and EUR 121.9 million in debt matched against the German asset.
Right. And by borrowing the exact same currency that the asset is denominated in, you perfectly insulate the balance sheet.
Make that make sense for the listener.
Sure. So if the Australian dollar depreciates by, say, 15% against the Singapore dollar, the converted asset value on your balance sheet takes a massive hit.
Right. The building is worth less in SGD.
Exactly. However, the exact same 15% depreciation applies to the AUD 518.4 million liability.
Ah. The debt is also worth less in SGD.
Precisely. The asset write-down is mathematically offset by the liability write-down, preserving the net asset value of the REIT.
It's a perfect mirror.
It is.
But the natural hedge only locks down the balance sheet. It doesn't protect the actual cash income, right? The rent being collected in euros and Aussie dollars that actually must be converted back to Singapore dollars every quarter to pay the DPU. So to defend the cash flow, management utilizes derivatives. We're talking cross-currency swaps, interest rate swaps, and forward FX contracts.
Locking in exchange rates via forward contracts, that ensures cash flow predictability. But this raises an important question because the analysis hits a very hard wall of opacity here.
Yeah, this is a major point of friction in the governance analysis. The sources explicitly state that the exact percentage of income hedged and the tenors of those hedges are simply not disclosed.
Which is wild.
Yeah. And just a reminder, a tenor being the duration of the contract. We basically have no idea if they are rolling 3-month forward contracts or if they have locked in rates for 3 whole years. We don't know if they are hedging 30% of their net overseas income or 95%.
And for an institutional investor, that lack of transparency is highly, highly frustrating.
Oh, I'd be pulling my hair out.
Right. You are essentially forced to just trust that the Treasury team is managing the derivative book competently, completely, without being able to audit the exposure matrix yourself.
And if a REIT had, let's say, 40% of its assets overseas, this level of derivative opacity would be a severe, potentially uninvestable red flag. I mean, if the euro tanks and you discover they only hedged 20% of their income on 30-day tenors, the DPU would just crater.
It would be a disaster.
But we have to weigh this governance failure against the absolute materiality of the risk here.
Exactly. Because the exposure is capped at 6%.
Right. Even in a worst-case scenario where their derivative strategy is just entirely incompetent, let's say the euro and the Aussie dollar both suffer a massive 20% structural devaluation against the SGD, and their forward contracts all just roll off simultaneously with zero protection in place. A 20% hit on a segment that only generates 6% of your total income equates to a 1.2% total drag on the REIT.
It's a rounding error.
It is. It is mathematically impossible for forex volatility to derail the 11.58 cent DPU trajectory given the current geographic concentration.
So we penalize the lack of transparency in our assessment of management's reporting standards, absolutely.
Okay.
But we recognize it poses zero structural threat to the underlying investment thesis.
Right. What is the verdict?
The verdict is unequivocally decent.
Decent, not flawless, but highly competent within their specific mandate. Let's cement the core pillars of that verdict.
Okay, Pillar 1. The DPU quality is exceptional, achieving plus 6.4% year-over-year growth to 11.58 cents organically, with absolutely zero synthetic income support and a negligible 0.4% fee in units dilution that demonstrates extreme operational competence. We acknowledge the structural drag of DPU growth at 3.1% CAGR, slightly lagging AUM growth at 3.6% CAGR, but the raw cash generation is undeniably strong.
Solid. Pillar 2, capital recycling. They are executing highly accretive yield spreads. The Ion and Orchard acquisition is a pure positive spread, and the Capita Spring deal proves their ability to synthetically engineer accretion through just brilliant debt structuring. Furthermore, they are funding these expansions by divesting mature assets like AST2 at near 10% premiums to book value.
Pillar 3. The risk management is mathematically sound. The natural hedges perfectly insulate the balance sheet from the 6% overseas exposure. The opacity of the income derivatives is definitely a governance annoyance, but completely immaterial to the overall risk profile.
And Pillar 4, the real friction point. The fee structure is a mixed bag. The 0.25% base fee is highly competitive, sitting at literally half the rate of peers like Keylare. But this is severely compromised by a pseudo-performance MPI fee that structurally incentivizes blind empire building, combined with a total lack of related party transaction fee discounts.
Ultimately, the management team is undeniably skilled, but they are playing a game where the rules heavily favor the house, the sponsor.
Right. They are brilliant drivers, but they are driving a car provided by CLI on a racetrack built by Temasek.
That's a great way to put it.
So what does this all mean for you, the listener? We have evaluated the driver today, but you absolutely cannot allocate capital based on management alone. We still haven't looked under the hood at the actual debt maturities and the raw balance sheet in Step 2, financials.
We haven't analyzed the macro headwinds facing Singapore retail and office occupancy in Step 3, business.
And most importantly, we haven't determined if the current share price actually offers a margin of safety in Step 4, valuation. You absolutely must tune in for the upcoming deep dives as we systematically dismantle the rest of the C38U